Hit it.
It's Friday, November 28th, 2025, episode 279. I'm Patrick Ceresna.
And I'm Kevin Muir. Patrick dusts off his chart book to tell us what he divines in talking charts.
And folks, we might even drink some beers along the way. And this is one of these unique moments. It seems it's been so unique where all three of us are actually lined up the exact same beers. So, Danny, why don't you take us a run through of what we're drinking here?
Of course. So today we have Hopeye from Rouge River, a hazy IPA, 6.8%. And they make sure to tell you on the front that it is strong beer. So
it's good. I mean, listen, it's a holiday shortened session. Like getting a little Thanksgiving buzz going is not a bad idea. So
it is if we have to drink this. Okay.
Right. So we know where your rating is going to go soon. All right, bud, give us a disclaimer.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much huddle may include the Turkey Day tape drift disorder, something that I'm definitely experiencing. The holiday liquidity lethargy syndrome. I can't even get it out. Like it's like the beer's already kicking in. That's otherwise known as the HLLS. And then finally, this is one that I think you're going to like, Patrick, the Silver Surge Psychosis.
Oh, yeah. Yeah. That's a bad one. We'll talk about that one when we get to our talking charts. All right, let's get Chase on.
It's our great pleasure to welcome to the show Chase Taylor, the founder of Pinecone Macro Research and head of research at Bulwark Capital Management. Chase, thank you for coming on.
Yeah, great to be back. Appreciate it.
I'm looking forward to this. And I was thinking about you the other day, and I was thinking that if I had to pick a guy that is the most underrated, like the value investor out there, the value research guy, you are definitely it, because your ideas you come up with, I love them. And the reason that we're chatting today is because I started writing something about aluminum, and one of our, mutual friends, Harris Kupperman, sent me something. He says, "Oh, Chase has already written all that up." And I was like, Newman, like, as I realized you're my Newman, like you beat me to the trade. So thank you very much for coming on. And why don't we just jump right into it, because you've been on the show a lot, so people know all about you, but we're not going to do any charts. We're going to have fundamentals, learn what you think. Let's start aluminum of it. You seem like it as well. Give us a bull case.
Yeah. So as you kind of noted in your recent letter, like you were kind of focused on supply. I was focused pretty heavily on demand. For me, it is a confluence of multiple things. For one, I've been staring at the futures chart for years, just waiting for it to break out, and it did finally do that. So then it's like, all right, well, now it's time to, it's kind of like the old Druck, like to do the research after you buy it kind of thing.
Oh yeah.
So I saw the breakout, and then I was like, well, let's go look into the story. And then I just realized, like, oh wow, like not only is this thing breaking out finally after going sideways for years, but it's doing it quietly because nobody cares about aluminum. And I love that fact as just on its own. But just looking ahead at the demand side it kind of blew my mind and it was like a confluence of other research I was doing, which we can talk about as we go on the electric stack and just a broad electrification theme, not to mention the cost of electricity, because that's really, at the end of the day, what makes aluminum prices go up, other than just pure supply and demand. Is the big input is electricity. And I don't think anyone thinks that's getting cheaper anytime soon. So just kind of viewing where I think the world is in 5-10 years from the kind of cars we're driving, the kind of electricity we consume, the kind of, even appliances we use, like you name it, like all this stuff is going to be using so much more aluminum than the stuff we use today. And, we were in a structural just overhang of supply for years and years. Finally, we got China to kind of cap their production. Even that, it took years to catch up to that. Yeah. And turn that, get that to where that actually mattered and turn into a deficit. Well, now all of a sudden you're staring at a deficit, probably a structural one for years. Now, I do think China will probably up that cap at some point, not in the next year, maybe not in the next couple, but because aluminum is so important for their manufacturing processes, like if it gets really expensive, I think they would respond. But even assuming you have a couple years of runway before they do that, though, the price has to re-rate significantly higher,
right,
to make it make sense financially for people to make more aluminum. So the supply side is good, the demand side is good. Just the future of the kind of products we're all going to be using 10 years from now compared to now, the demand's going to explode. The electricity is obviously getting way more expensive. Like it's hard to come up with, like, honestly, a better narrative around a boring asset than I think you have right now for aluminum.
So why don't you tell us a little bit what you mean when you talk about the electric stack? Like, walk us through that kind of big macro view that you have.
Yes. So I just wrote a huge piece about this, and a lot of it was based on an awesome piece called The Electric Slide, which is like a 200-page book masquerading as an article, but and it goes through and it shows like the cost curves of all these different technologies that has collapsed to make like new things all of a sudden that went from being too expensive make sense. And it's stuff like lithium ion batteries, it's magnets and electric motors really are just magnets mostly. The electronics, the power electronics that run this stuff, the compute that's embedded inside of this stuff. And what I'm saying is, like, think of like EVs and drones, things like that are running on these batteries that are running with electric motors to make the things move. Robots, if you think robotics is getting real, whether it's just stuff in a factory or you're going to have, your own humanoid robot, like doing chores for you or whatever, like all that stuff uses the same kind of batteries, the same kind of electric motors and compute. And all this stuff requires a bunch of aluminum, not to mention a bunch of like nickel, cobalt, lithium, like you name it. So, and I think, in America, like I can speak to the fact that electricity just got totally politicized. Like so many things in America, like you have to be on, team A or team B. And we just like had a draft and everything ended up on one side or the other, to include electricity. It's like, you have to believe only in these kinds of electricity and energy if you're on this side of the debate. And that obviously happened with electricity. If it's green, then, the political right thinks it's bad no matter what. And I think there was really compelling narratives that a lot of green stuff didn't make sense, 5 years ago, 10 years ago. Like it wasn't particularly economic. Like there was plenty to point at that it wasn't good. But then you look at the complete collapse of the cost of some of this stuff. If you kind of rerun the math, maybe you ran 5 years ago, because it's what I did. Like I was like, wait a second, like hold on. If it really produces for that price, like this actually makes sense now. So a lithium ion battery, yeah, like EVs didn't make a lot of sense 5 years ago, 10 years ago, but now they do. Like they're actually getting economic. And because these cost curves keep coming down, you have to assume things like grid scale batteries, EVs, like all this stuff just gets more affordable. It makes more sense. It outcompetes forms of combustion and, thermal energy slowly over time. So the way I see it, more of the world becomes electrified. So think about your leaf blower. Like it was weird to have a battery leaf blower 5-10 years ago. Now it's weird to have a gas one. And that's going to be the same for so many things that, think about, a generator at your house. Like those were never batteries. Now all of a sudden, a lot of them are. And that, I think 20 years from now, you'd be a total weirdo if you didn't have an electric battery as your, home energy backup. So what I see is more and more things that plug into the grid, which means we need a lot more power on the grid. A lot of that's going to come from things like solar. Again, all this stuff requires a ton of aluminum, like a shocking amount of aluminum. And the interesting thing there is like you get this feedback loop where the price of power goes up and that makes you need more aluminum to get more power. So, right. It's kind of an interesting feedback loop that you can easily see kind of forming itself. The more expensive power gets, the more expensive aluminum gets, but the more you need aluminum to offset the problems that you created with more expensive power. So
it's one of these things where this electrification of the world is finally kicking in. And it's like the market is, we were all excited about this, 5 years ago when everyone was talking about it. Now it's finally hit the point where it's gone mainstream, and yet very few people are talking about it, right? Like it's not like we're not sitting around trading solar stocks like we were 5 years ago.
Yeah, well, I am, but so one what's funny about this is I wrote a piece like early in the year, and this was no kidding, just because it's like, I know you can identify with this, like the contrarian streak in me. Like whenever I saw everyone tossing all their green like equity in the trash because of an election, I was like, hold on, let's dust that off and see what's in there, right?
Right.
And then you go look at it and you're like, hey, this stuff's performing okay. Like it's, the first quarter, it was standing up to the loss of tons of subsidies and everything. Not to mention everyone just selling it because of the election. So you go and look at it, and then you go and look at, okay, what does this stuff look like 2-3 years from now? And you're like, yeah, actually, it's still growing. A lot of these projects are still going to happen. Like, and even if the US decides no more of any of it, like the rest of the world's not deciding that. That just means India can be like, yeah, we'll take those free solar panels from China or whatever.
Right.
Like, so, but if you look at the performance of, you can go like the iClean ETF, the TAN ETF, you pick, right? Electrification ETFs. All this stuff has dramatically outperformed the S&P this year. It's dramatically outperformed, old school like energy equities, like, and not to mention that, but the interesting thing about old school energy is a lot of the like oil and gas services people are really tapping into this stuff. They're getting involved in the battery side, the lithium side. You have like Liberty Energy. I'm trying to think of the name of the other one that are doing like microgrids and boilers for data centers. So you actually see, like, if you look at the XES ETF, a lot of people are like, man, it's doing good, even though oil's doing bad. And you're like, yeah, look under the hood at the big winners. Oh, pump is the other one, is the symbol for the other one. The big winners are like actually tapping into a lot of the like kind of quasi renewable green stuff.
Oh, I got it. Okay. So the world is changing. The markets aren't talking about it a lot, but it is actually behaving like that. It's going up. Why don't you talk a little bit, like you've mentioned aluminum. One of the things that you did, you just bought a basket. Is that generally how you're viewing a lot of these things? Is that it's a big macro theme, something you want to hold for many years, so you're buying baskets of all these? And why don't you walk us through some of the different baskets you like, or the different ETFs that you like to take advantage of this longer term play that you see?
Yeah. So when it comes to aluminum, first of all, I'm just not good at picking single stocks, period. Like, I'm not good at it because I find it boring to like dig through one company for, days at a time or something. So a lot of times my attention span limits me from doing that stuff. So, but there's, not surprisingly, there's not an aluminum producer ETF out there, right?
Right.
So this is one where you're like, all right, you got to go make a basket. So what I did was I made a basket of the common stuff that trades here and in Europe a little bit, and then in China. So what they all have in common is all this stuff trades pretty close to like 10 times forward earnings, like close enough if you averaged them all out. So it's all cheap. My favorite has been Century. But it has, you could argue, too much US exposure. If the tariffs go away, then that becomes a problem for it. Like you, I very much like Alcoa, and for the same reasons. But there are a couple Chinese names that I'm in, trade on the Hong Kong exchange. There's one in London, S32, and then the one up in Norway. Like, so I just kind of spread it out. I try to take a basket approach to mitigate the fact that I'm not going to keep up with any single name well enough.
It's funny. When I wrote my piece, I got a note from our friend Louis Vincent Gavin. He's like, just buy Chalco. I don't even know what that is. Is that their biggest one?
It's the China Aluminum Company, I think.
He said, just buy that and stop making your life so hard.
I mean, that stuff, like the ones in China have big dividends. They trade at nothing. But they are having a good year.
Yeah. So your basket.
So I struggle to argue.
Yeah. I saw your piece. You wrote it, and it's just taken off, and it's been a terrific trade. Good for you. All right, let's talk about, this electrification is more than just aluminum. That's one way to play it. But you have, you've mentioned solar and stuff. Are you just buying the TAN and those ETFs, or do you have names that you like? How are you playing this? Like, talk us about how you're setting up portfolios for this.
So I wrote this piece about the electric stack, and it's because I'm used to just being like, here's two ETFs in the futures or whatever. Like this time it was like, all right, you know what? Like I need to actually make an electric stack basket, take it more global. So what I'm doing with that one, and I'm still working on it, so I don't have great like update now. I put together 20 ETFs, and it includes like the electrification stuff, the green metal stuff. One that I really like is EVMT, and I swear no one knows about this. It is I think it's Invesco, and it's EV like battery metals.
Yeah,
and it's
I see it here.
It's one of these that, you know, takes a little sliver of the book, puts them into the futures of these things, and then has the rest in T-bills, so you get a yield and the exposure to the metals. So
I see this.
I love
this
the way
is
that's
crazy stuff. Lithium
I love the way it's put together.
hydroxide futures,
Don't
cobalt
ask me what that
metal,
means.
like some nickel. Oh, that is fascinating. Like, this isn't just like an ETF that's holding different miners. This is actually an ETF that's holding these kind of illiquid futures contracts. Well, that's fascinating.
Yeah,
EVMT, Edward Victor Mary Tom, for those who are interested.
Yep. So that's
All right,
one I
what
like
else?
that comes to mind. There's a lot of them out there. I mean, I think a lot of people probably know the Grid ETF, GRID. I think that one's pretty solid. When I look for these, what I want is one that I pull up the holdings and it has like 75 holdings all over the world, and nothing's more than like 3%. So like a lot of the ones I like tend to be that way, instead of like, oh, I have like 14% Bloom Energy, and it's like, no, thank you. Although I find Bloom Energy actually pretty interesting. That's another avenue I think is worth exploring for people, is the like power cells. Like,
but isn't that, though, like, going back to your comment that you went and dusted off the stuff that people were throwing away, isn't that almost the opposite, the Bloom Energy? Because that feels to me like the poster child of the AI trade, and it's like so volatile, so emotional. And I'm assuming it's trading at ridiculous valuations. Am I wrong?
Oh, it's more than ridiculous valuation. But what I think it deserves a spot on a watch list in case it comes back, like in the, like, you know, AI drawdown here we just had, which, you know, was not a big deal despite what, you know, FinTwit would have told you. Like, that thing got nuked. It like got like cut in half.
Oh yeah.
After getting, you know, going up to 10x, but
150 down to 78, like within a week. Like, it was fast.
Yeah. And I got excited. I'm like, hey, maybe it's worth it now. And I looked and it was still like 200 times earnings or whatever. And I was like,
Well, at least it's on 200 times sales like Palantir.
But it's worth putting a pin in, because as these chemistries, you know, improve, and the beauty for them is the speed. So as long as these AI guys are desperate, they will use them, because it's like, hey, do you want power in 2 years or 2 months? Because we'll do it in 2 months. And you know, while you're trying to make a digital sky daddy, as I like to call it, like you're going to take the 2 months because you're afraid someone else will get there first.
Right. One of the things I like about you, Chase, is that you're actually, your background, you're an engineer, if I'm not mistaken, right? If I remember correctly.
You are mistaken, but
okay. Or you're even better than engineer. You're going to be like a nuclear physicist or something, right?
No.
Okay.
My education is in intelligence studies and in foresight, which was a degree in our engineering department. But no, but in my background though, I worked with a lot of engineers.
Okay.
And to be fair to you, on the like hardcore side, I did work with rocket scientists a lot. So
okay,
I worked at a rocket research lab for the Air Force. So
right. So you're not somebody.
I'm not that guy, but I worked with them a lot.
Right. So you when you're going and looking and researching this stuff, it's not like you're just reading it and falling in love with it. You're thinking about the actual, you know, fundamentals of the science behind this. Is my point. More so than just some stupid trader like me that's, you know, flipping buttons and buying and selling stuff.
Sometimes the less you know can be quite the best.
Yeah,
so
well,
I think we both know that.
That's right.
And as we both know, like, the people that love things least are the ones that know it best. And does that take opportunities away so often?
You're absolutely right.
Yeah, it's happened to me. So,
all right. So you talked about this opportunity in the electrification of the world, the electric stack, as you talk about it. And one of the things, though, that you might think is that if you were to just take that viewpoint, you would think, oh, Chase loves electric stuff. He must hate old-fashioned energy stuff. And that is not the case. Back to your point about that you don't think you should take one side or the other. Walk us through why you also like things like nat gas and think that there's opportunities in traditional energy place.
Yeah, I'll start this by saying a lot of this stuff we're talking about from the electric side really depends on idiots writing Sam Altman checks for a while longer. as long as that's happening and they are chasing the digital sky daddy, like, then you're going to have like hungry hippos for electricity. And as long as you're playing hungry hippos for electricity, like, you absolutely, like, gas is going to play a huge role, whether it's, it's not just the gas plants, but also, gas being used in some of the cell chemistries and stuff that they're using, or, the basically junky, like trucks and stuff that they're like just lining up that are run on like diesel or gas and then plugging them into data centers. Like, it's quicker to get to market, just through Caterpillar or something like that than a lot of this other stuff. So it will be very important for electrification in the US, for the next few years until, we actually do get around to building some nuclear plants, which it sounds like we're going to do eventually. It is definitely a big bridge fuel for that stuff. But so I'm very bullish on gas, especially if we're going to keep increasing exports of it. Someday, our friends at Gehring and Rosenzweig will be right about the peak shale stuff. And like, in that moment, this stuff, it gets very, very important. Now, I have no idea when that's going to take place. They've made a compelling case to me for 5 years about, the high grading and stuff. And on some level, that has to be somewhat true, I think. And obviously, if oil gets low enough, which it very seems possible to me in the next few months, then you could disrupt production and associated gas production. Right now, they're making way too much, obviously, to me anyway. But I think gas has a plenty good future because we need it for the electricity. And if we're going to export more and more, like the supply and demand balance, to me, suggests you can have, $7 gas as like almost like a new break even over the next decade compared to whatever we were, $2.53 over the last decade.
Just because the demand side's so strong? Is that why?
Because the demand side will be so strong, especially because, you're exporting more and more of the production. But then, the electrification side, like you can't do the nuclear fast enough. You're currently politically hamstringing the, kind of solar, wind stuff, battery stuff. Now you still are connecting a lot of that to the grid. And to quickly go back to aluminum, one of the big bottlenecks for transmission of power is like our old power lines aren't very good. So reconductoring those is a huge demand shot for aluminum, but it really creates a lot more efficiency on the grid. So you can get way more out of the current grid just by reconductoring the transmission. So I think that is, somebody will eventually figure out how smart that is, and they'll pull that lever. And when they do, like it's another nice, shot for aluminum. But I think oil will eventually get around to finding a bottom. I think it may take the 40s to get down there to find that bottom. But I know Saudi Arabia clearly likes helping President Trump, and they're getting some stuff on the back end for doing that. And that's probably of value. But I don't think they want to deal with $50 oil for, half a decade or a decade. So
right.
I wouldn't be surprised if they end up pulling back a couple of years from now, or maybe even a year from now. And if we get into the 40s to wash out some of the more, kind of low end producers, then oil can itself get going again. But my changed views on things like solar and lithium ion batteries, though, it does have me questioning my like longer term bullishness on oil. When you see the demand figures out of China, like properly for oil and just gas powered vehicles, like it's crazy how much that has leveled off. So, and even that you have natural gas trucks all over China now. So like the kind of oil to gas switching, and then the oil to just electrification switching, I think it's a genuine threat. I think a lot of people like to make fun of that and think we're going to be doing 200 million barrels a day of oil, in 30 years or something. I don't see it. I think oil can be close to flat from a demand perspective, up 0.3, 0.5% a year instead of the kind of old school 1% a year moving forward. Because I think this electrification stuff, the electric stack stuff it's just better.
And so that's why you like nat gas better, because nat gas, as you say, is the bridge to electrification until we get nuclear. But what about, isn't there a problem with coal? Like, is it like, aren't they competing? And isn't it, if we were just to put aside what we think about, pollution or whatever, like I know nat gas is cleaner than coal, and maybe I'm wrong, maybe it's not. But if you were just trying to, sorry, if you were just trying to maximize your energy, isn't coal able to do it all? And are we really for sure that we're not going back to coal?
So, I mean, we have definitely not, other than in the US and some places in Europe and stuff, it's not like we even left coal to begin with.
Right.
But I think personally that we might actually finally start to hit global coal demand, mostly because China can start to move past it. Like China's grid is twice the size of the US's now for their electricity production. And like, while we have shortages and high prices, they basically have too much electricity at this point, and it's crazy cheap.
Really?
Which is, yeah, they have massive amounts of electricity, and they're still, building way more batteries and solar and everything than we are. So not just do they have enough today, but if you look at where they're at 5-10 years, like they're more than fine. So from that perspective, like,
so they've already run ahead, like they did it properly. Instead of going to electric cars and then deciding they better work on their grid, they worked on their grid and then went to electric cars.
Yeah, they just did both at the same time.
Or both at the same time.
And to preach more on the electric stack real quick, like one of the interesting things to me, and one of the reasons you asked for like investment ideas, my personal biggest position of anything I own is BYD. I think it's maybe the best run company on earth. And they like personify the electric stack because they're making these EVs, they're making drones, they're making iPads, like they're making robots, they're making trains, they're making forklifts, like they make everything. And I think it's hard for people to think about this, but like if you think about the difference between an automobile and a phone and like a computer, like 20 years ago, 30 years ago, and then you think about the differences between those things today, like they used to be just completely different animals, and now they're not that different. And I think that's why you see like phone companies that go from just making phones to cars in China.
Yeah, like
5
that
years.
Xiaomi or whatever, right?
Exactly.
Like,
yeah, and there's a couple of them, and they're making good cars, but they're also making all this other stuff. So like, I mean, BYD makes everything. If you just go peruse all the different things they make, it's like, wow, they make that too. Like there's a sky bridge like train in LA that's made by BYD, right? Like
you're kidding.
No. So like they're doing all this stuff because the way to view the electric stack is like they're like Lego blocks, and every time you snap them together, they become more valuable. So China has basically gotten this entire vertically integrated supply chain where the more they integrate with themselves and each other, the more like value gets created along the way. And BYD to me is like the poster child of that value creation.
Okay, so let's zoom out a little bit. BYD is a company you love, but it's also China as a whole you are attracted to and think that is a good investment opportunity. Walk us through your China bull thesis.
Yeah, this started. So let me start by saying I was a China perma bear from 2018 until this year. So it was really December that I started to change my mind on that. And that really came back to just, this is something you and I shared a lot, and that is fiscal stimulus. I felt like China, first of all, their monetary policy, which people focus on for some reason, could not mean anything less to me. They're already pushing on a string, and they have been, for years. There was just like no point even looking at it. But on the fiscal side, they kind of made it clear like they were going to ramp it up at the end of this last year. And it was I've never felt like a more dissonance between myself and like, call it the street, like, just big name, whatever, big shops and their view of something. Like a lot of people are like, yeah, they're doing a little bit of stimulus, but it's not that big a deal. But if you like dug into the numbers, it was obvious, like it was going to be a massive year over year impulse on the fiscal side. And they have like 8 different kinds of budgets, and it's not easy to get into and research. If you just look at like one certain national budget, it's like they're not doing much. Like, yeah. But like go look at the provincial level and everything, and like these special bonds and stuff that they're gonna do, like it's like they have like 3 different balance sheets you gotta look at it. But if you did, you could see like you're talking massive fiscal stimulus. And the beauty of that was like if you looked and were like, it probably won't get their economy ripping because the economy has, you know, a massive suck coming out of housing and stuff. So like the best thing you could ever have in the world is them trying to, you know, get the patient alive with this fiscal and it not working and them just being like, well, we have to do more, which is you're already seeing. They're talking about doing more and they are directing a lot of it more towards the population, like subsidizing like elder care and child care and stuff like that. Like not to mention just, you know, buying like stuff with their kind of cash for clunkers across appliances and everything like that. So I just saw all that and it got me excited about China. But then really in the last year, my entire view of China has changed. The popular narratives surrounding China, obviously, is like, oh, they steal our technology. Yeah, they're pretty decent manufacturing, but they don't, you know, innovate. If you look into not just where that is today, but think more deeply about where that's going in the future, it gets really obvious really fast that not only are they innovating today and out innovating us in important areas, but if you look at human capital, which is everything in economics and markets, in my opinion, over the long term, their human capital stock is going to be so much better than the West's because they take serious education so much more seriously than we do. And if you look at like things like patent filings, how many people are getting masters and PhDs in really important subjects? I mean, they have more mining engineering programs than we have mining engineering graduates almost. Like it's anytime you look into any of these like hard sciences and like R&D type stuff, they have more people that are taking it seriously. They have more resources dedicated to it. Not to mention they're attracting global talent in these areas in a way that's, you know, kind of under talked about. So when I think about their human capital today, where it's at, you know, in the future, and you talked about, you know, Louis, like they had that recent piece that showed like, if you just take like the same like Tesla vehicle there versus the US, and they're doing like twice as much production per employee. And that perfectly encapsulates it. But again, they are innovating and they're starting to innovate in places like biotech and all up and down this electric stack thing. Like, I mean, they're just running it. And you look at some of the features they have on some of their automobiles, and not to mention their trains and drones and everything. And it's stuff we do not have in the US, especially for the price and the quality. So you're going to see more and more innovation that explode, I think, out of China. And obviously that's worth money. I mean, so it's hard not to be bullish on someone that is mastering what I believe is the technology of the future in that stack and has a significant human capital advantage moving forward.
Right. Just as an aside, you know, I think both of us are contrarians at heart. Do you remember the peak? You can't invest in China. It's uninvestable. That was like you used to hear that all the time. And it used to be, and I loved Louis' line that he used to go around at the peak of that, because it wasn't that long ago. Everyone forgets. It was probably a year ago that it was peak. You can't invest it. Yeah. And Louis would be like, okay, I go to people and I chat with them and I ask them, like, you know, I hear you that you can't invest in China, yada, 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 about the Taiwan Strait, you know, the Taiwan, whatever. And then they go and he says, well, tell me, what's your biggest position? And he'd be like, NVIDIA. And he's like, what do you think happens to NVIDIA in this? And it just, to me, that was the most amazing thing, was that people were just record long NVIDIA pumping. And at the same time saying, I can't invest in China because there's too much risk. And I'd be like, it just makes no sense. And like, I think we're going to look back at that, and that's going to be one of the most crazy periods that we ever saw.
That was pretty classic. In the piece I wrote, it was literally the first weekly piece I wrote this year. It was a very bullish China piece. And I went to look for bearish economist covers on China. Yeah. And I only went back like a year or two, and I pulled like 6. Like it was so easy to find. And because I saw like one like mildly bullish one recently, and I saw someone posted like, oh, sell China. I'm like, come on, like here's 6 bearish ones from the last year. Now I do. there's some people starting to change their tune on it and get a little bit bullish, and it already makes me uncomfortable. I don't like it. But,
you're like me.
but yeah.
You know, we have to learn that when people start agreeing with us, it's not all bad. Like we can be with the crowd for a little bit. So
Brazil is a perfect case of that. I got out of Brazil earlier this year. It's like every bro on Twitter likes it. I gotta move on.
And to your point about China going up the value curve, I think that is the story that everyone's missing. A lot of folks will talk about it and they think like, oh, they're great at making little toys or making this or making iPhones or whatever. And they're missing that they're like making tractors and trains that they're not selling to the US, and we don't see them because we're not allowed to buy from them. But then you go around the world and you'll see like, oh my God, that's Chinese. And it's really far up the value curve. And that's the part that I think so many folks are missing. And I've never thought about it in terms of the human capital, the way you put it, but that's a terrific way of also thinking about it.
Yeah. I mean, you just look at BYD, like their Blade battery is essentially the best EV battery there is. And one of the things I like about them is they reinvest heavily back into the business. So they take the cash flow, they turn it back into the R&D. And obviously our mutual friends, you know, with Cuppy and Rupert, like they all got to go see the BYD factory. And I mean, they all kind of came away pretty lit up about what they saw. Like that stood out to me as someone who has a lot of their money in BYD. And I mean, they have like 100,000 plus, you know, engineers, and a lot of those people are doing R&D. Like they're not just building cars and twiddling their thumbs and thinking about the past. Like they're thinking about where this stuff goes 20, 30 years from now. Like one of the most impressive things I've ever seen in investing has to be Charlie Munger giving BYD money years and years ago when he did.
Yeah.
Like it's hard to do today. No one wants to own it today.
Yeah.
But if you go back to when that just blows my mind. It like gives me chills to think about how smart that was.
It really is. All right.
I remember thinking the old man had lost the plot whenever he did it.
Yeah. Oh yeah, that's right. You're not buying Tesla. You don't know. You don't understand. And he was going with and I think he did look at Tesla, and I think that Elon scared him off, and then he went with the BYD. All right. So when you're coming to play in China, you obviously like BYD. Can you just buy a basket and close your eyes, or you know how does it stand on that basis?
Yeah. So I think the easy answer is yes. You can just buy one of the Chinese ETFs and you're going to be fine. But for people that are down to get their hands dirty on single names in China, I think the amount of money that's going to be made in single names in China, putting in the work in the next couple of decades is going to be significant. And I finally started to do that for myself. Like, and I hit up mutual friend Leonid Mironov, and like,
oh yeah,
even with this, I'm like, hey, help me. Like this electric stack stuff, I could not be less competent on single name stuff in China. So I had him helping, you know, just give me a heads up on like where to look and some of the names to like at least take a look at. So, and I'm finding, I did the same thing with nuclear, and I mean, they have a giant supply chain of that. Speaking of like, China doesn't innovate. They're like a generation ahead of us in nuclear energy. Like to go back to, they don't innovate. It's just nonsense. Like in that whole supply chain, you can find amazing value within it. One thing I will say that's notable to me, broadly speaking, in China is the higher you get upstream, the worse things are. Like a lot of their commodity producers, they have like just terrible margins. They don't make any money. They're barely staying alive. And then, you know, the stuff between true raw materials and like those end producers, a lot of that stuff is just brutal. Like they haven't made any money. To go back to the anti-involution thing, a lot of the problem there is upstream. So the beauty of that is like, obviously, whenever we have less EV companies and less cutthroat competition, that'll be great for BYD. They'll be able to make a little bit more money. But I think it's going to actually be best for all of their suppliers at the end of the day. They just have way too many suppliers of all this kind of stuff. So if you go look at the charts of anything, you know, find a miner of some battery metal or something. Like obviously the battery metals have been in a giant bear market, and that doesn't help. But you go look at the charts and evaluations of a lot of the upstream stuff in like the electric stack, and it's just been brutalized. So like BYD's, and you know, it's an over 50% drawdown, I think, even still. And but compared to the people they buy stuff from,
Right.
It's they're doing great.
And do you think that we talked earlier about the stimulus? It feels to me like they might be rolling over again, and they might need a stimulus any day now. Do you think it's coming?
Yes, I don't know exactly how they'll do it, but yeah, absolutely. I mean, they don't build as much infrastructure as they used to, and they don't build near as much housing as they used to. But the funny thing to me is, 5 years ago, everyone was saying, like, what are these idiots doing? They need to stop this housing bubble, and they need to stop building all these empty apartments and all these bridges to nowhere. And then they did that, and everyone's like, these idiots, they're going to collapse their economy because the banking system can't handle that. And you're just like, I would, as an American, I would do anything for us to see a dumb policy and just be like, let's stop it, instead of being like, well, people might get sad if we stop this dumb policy, so let's keep it going.
Right.
So and I still get stuff from my clients all the time to be like, yeah, but the property crisis. I'm like, that's like the best news that's come out of China in a decade, that they were smart enough to kill that before it became an even bigger problem. And I'm not saying it's not a problem. It's just,
100%. Not only that, from a young person perspective, it's actually terrific. And like, would you rather be, someone that's the property's coming down, or that you're getting priced out of? Right. And we unfortunately have the opposite problem, and young people can't buy a house. They can't make a family. Now, China's still got that problem because they don't have a big enough social safety net, and they're just refusing to do enough to cause, a little bit of make their citizens feel a little more secure in their finances and their long-term finances. But I think it's coming. I think they're headed the right way. And I'm with you. I think that there's a lot of positive things happening there. Let's talk about real quick
to talk about something there is because it's not particularly smart or safe to just save your cash or put it into housing anymore, because that's where everyone's saved.
Yep.
It's like that much more impetus for people to work their way into the equity market in China
100%,
as a way to save long term. Plus, I think a lot of people made a big deal of like the shareholder friendly reforms you got in Japan over the last 5 years, in some other places. You had all that in China too. Like, if people aren't putting cash to work, they're getting kicked off of exchanges, things like they're doing all the same stuff that Japan did. One thing China's always been good at, in my opinion, is learning from Japan, and I think they did again on that. And if you go and look at how many IPOs you're getting versus delistings and stuff, it's like a very underrated thing in equity markets is the supply and demand of equity. Yep. Turns out it matters, and the supply and demand of equity was a huge problem in China and Hong Kong for really the last 20 years at least. And if you look at that, it's really shored itself up lately, and that's an underrated reason to be bullish.
Well, that's a great point. Okay, we talked China, we talked electrification, we talked energy. What about real assets in general? Like, is there something else I know you're bullish on them? Are there other ones you like? Like, everyone's got an opinion about gold these days. Why don't you tell us your opinion on gold?
Yeah, for me, I think U.S. policy and U.S. policy trajectory is just it's ungood, as I like to say. So I know everyone now thinks like stable coins are going to save the dollar and make it great, and I don't really see it that way. So to me, I do think the dollar is entering a what will be a secular, unfun point for a while. So
ungood and unfun.
Yeah,
okay.
Yeah, those are some of my favorites. And just because of that, because I think we're not going to fix the deficit situation, we're not going to take any of that stuff seriously. We've had massive capital inflows from the rest of the world for so long. I think it's going to be natural for that to at least flatten out, if not go in reverse. And that alone is so problematic for U.S. asset prices that I want to have more in real assets than I want to have in U.S. financial assets. Plus, we had the big fiscal in the U.S., in the last, 5-10 years or whatever. Now the rest of the world's jumping in the party. Like, everyone's doing it. Like we talked about, China's going big. Well, Europe's going big, and we're telling Europe, like, hey, why don't you defend yourself, give us trillions of dollars, and stop exporting stuff to us, without stopping to like pencil out the math and go like, hey, this means capital outflows. Like they're gonna have to take some of their trillions home to defend themselves, and all this stuff. So
that's
a lot of money that goes.
We're all of a sudden, instead of we're all of a sudden sitting there in Canada, and we're saying, okay, fine, we need to retool our whole economy to be not just dependent on the US to sell to them. We need to open markets. So we've gone from a 2% deficit to 5%, 6%. Now, do you worry about that? So yes, one of the consequences of that is obviously more likely a US dollar that goes down. So I'm 100% with you there. Do you worry about the perspective that it's going to be more difficult to fund the deficit and that you actually might have a Liz Truss moment? Like, I know, listen, I know you're not going to be like one of these doom at 11 folks that's going to be like, yeah, the world's going to come to an end. I get it. But you still, is there a little nagging part of you that kind of says, this trajectory is wrong and this is actually going to be more of an issue than folks think?
Yes, I think markets are much too sanguine about that personally. Now, obviously, they will find a way to fund the government. However they can do that. If that's, my assumption is we'll have some version of capital controls, and we'll have some, the financial repression stuff where it's like, oh, X% of your IRA, your 401k has to be in T-bills now, like stuff like that. Like, okay. So I think all that is coming, but the question is where's that point on the 10-year or whatever that they're like, enough's enough. Where's the yield curve control like lever? Where's the trigger hit? And that's a tough question that I don't know. But when I look at 10-year inflation swaps and stuff, or even honestly 2-year inflation swaps, look at term premium, like all this stuff to me says like, who cares? There's going to be no inflation. The deficit doesn't matter. And I think both are probably incorrect. Now, can we have a recessionary dip in inflation? Of course. But when I think about the response to that would be coming after, like, I don't see disinflation on a secular basis at all. You can always make the cyclical case for it, but on a secular basis, just not at all. Especially now that, you're competing globally for the stuff you buy with your fiscal stimulus in a way we didn't have to for so long. And as we all of us commodity bros know, like, the lack of investment in most of these commodities for the last 15 years has been really low. I mean, so like you look at copper, and one of the beauties of aluminum is it's basically just hitched itself to copper. If copper goes up, people switch from copper to aluminum for a lot of stuff. So, copper supply and demand's horrific for the next 20 years. And it's not like you just flip a switch and go open some new mines. So I think for a lot of commodity prices can re-rate, and the Bloomberg Commodity Index, they have an ETF for that, the BCI, and that's a wonderful chart. And I think that's one of those kind of easy button ways to just play commodities.
Wait, I didn't even know about this. What is this? Who makes this? It is the ABRDN Bloomberg All Commodity K1 free Aberdeen, ETF. Yeah. Is it Aberdeen? Wow. And a lot of these people are smart enough to go with the no K1 routes because they realize those of us in the industry get hate mail if we have K1s in people's books. So wait, I'm sorry. I'm a Canadian. I don't know. What's a K1 and what's the issue?
It's like this ridiculous like tax paperwork, and it goes out like after you've done your taxes often. So you will have like been done with your taxes and you'll get this K1 in the mail. So like anything is like a partnership or things that oftentimes we'll use like commodity futures and stuff. They used to all have K1s. So like MLPs, stuff like that will have them.
Right.
So like you think you're done with your taxes and then you get mail and then you have to take it back to your tax person and they have to go redo it. And so it's genuinely a giant pain. So it's like for us at Bulwark, like we'll cross-check everything we put in the book to make sure it doesn't have a K1 first. And for a while, like that really held us back in like commodity ETFs. But now all of a sudden people are being smart enough to be like, no K1. So EVMT, no K1.
Got it. Okay. That's good to know. Back to your point about the financial repression. I'm just going to toss an idea, to you and see what you think. I used to think that it was going to take an extraordinary steep yield curve for us to get YCC. Like I thought there'd be a panic. So when people would tell me, oh, he's going to do YCC or someone's going to do YCC, I said, you do YCC after there's a crisis. You don't do it ahead of the time. Right. Same with like when it came to the CPI and people would say, one of the worries that I always had when I would go, talk about inflation swaps or talk about break evens is that eventually the government just changes the rules. They go, this is too expensive. I'm just going to change how inflation's done. And they've already done that to some extent, like the whole hedonistic adjustments. But one of the things that I've come to the conclusion of is that I used to think that those things would take a crisis before they changed, meaning we would have inflation go to 5-10% for a decade, and then they would change it. Or meaning that the yield curve would go to record wides before we got into trouble. One of my theories is that Trump is an accelerant. Like if you think about him, everything is happening faster than you would ever expect under him. And I'll just take, for example, like him firing the head of the BLS. Like that was like one bad employment number and he fired him. So I'm sitting here going, okay, like what's going to happen if inflation's 5? Like it's going to change. And so one of the things that I've been thinking about is that in the past, I thought the YCC was a long way away. I could almost see them doing it preemptively, which I never used to be able to think about in the past. I thought that it would take a crisis before they would do it. Now I'd almost like see them going, you know what? 10s are 3% and then we're going to leave them there.
What's super interesting to me about this, it's bizarre, but if you check out like what like the folks like Bessent and Myron have said, they're very anti-Fed balance sheet. They don't want them housing a bunch of treasuries, and they don't, especially duration. So a lot of them want to sell off the duration and reinvest into bills or whatever. Like, and I'm like, dude, you are gonna need all of that. Like, I know. What are you talking about? Like, this is another thing you're gonna have to flip flop on in a year whenever you got to go hoover up all the 10 years. It's weird.
Or they're going to put rates down to 1 or 0, and then we're going to have a 10-year at 5 or 6, and it will be record wides, and I will have been correct there. But you're right.
And there's so many people that say like, who like just keep doing the bills thing. Like, I don't think people understand how inflationary dramatically bringing down the issuance in the time frame is. Like, the closer you get to a 1 month bill or whatever, the closer you are to real money and not, a savings instrument. Yeah. Like you're just asking for an inflationary problem if you do that. Now, to date, it's not that big a deal. If you look at, and I know I've seen it from you, like the average weighted maturity of the treasury, like outstanding, like, yes, it's coming down, but it's not some catastrophic, like, oh my gosh thing. Yeah. But it feels like they might want to play with it becoming a big deal and catastrophic eventually.
For sure. It's just wild. But at the end of the day, when I think about, okay, so they do YCC or they do any of these dramatic things, and I'm like, it all ends up in the same thing, which is US dollar for sale. That's that's where it ends up. And one of the things, Chase, and I always think is funny, I have some buddies that go around the world and they'll be like, oh man, I'm in Brazil. You should see how cheap it is. And then I'll be like, oh man, I'm in Italy. You should see how cheap it is. Oh man, I'm in Japan and see how cheap it is. And I'm like, these places aren't cheap. You guys are expensive.
Exactly.
And what I find amazing is like how, like, I'm actually shocked that Trump hasn't gone after other countries yet and tried to talk down the dollar more. Because ultimately, if you want to put the middle America to work, you can't do it with the dollar. You are the most expensive currency in the world, almost. Like, yeah, Switzerland's more or whatever, but on the whole, you are the most expensive currency in the world because of all of the capital that has been going there for the past 10, 15 years that has just been flowing in there. It's the most expensive country in the world. And so the reality is that if you want to put people to work, you need a lower currency. I'm shocked it hasn't happened yet. He's not screaming at Japan and he's not screaming at China to get their currencies, up. Are you?
Yeah, I totally agree. And it was interesting because even early on, I think a lot of us expected that. And then like it was instantly like both sides, US and Japan, would come out and say like, oh, yeah, we didn't talk about currency. They went out of their way to even say that. I'm like, why? Like, why not? And as bullish as I am on China and I'm a fan of where they're headed structurally, like they have absolutely ripped us off by keeping their currency as low.
Oh, 100%. I completely
That's where they got
agree.
us, right?
Yeah.
Yeah. At the end of the day, like, sure, like we've all stolen technology over the years to catch up and all that stuff. Like US did that big time, but that's normal. All this stuff's normal, but they have absolutely sat on the currency and that gave them a huge advantage. So to me, that's the way you fight it. Maybe stop buying Argentine pesos and start buying, some yuan and euros or something. But
yeah, well, the other thing is eventually, like, one of the solutions is to tax people that are investing in the U.S.
Yeah, but that's
I know,
like
but
that,
then the stock market goes down, and then, but
right.
So this is always what
You're right, though.
What I always found inconsistent about what folks wanted to or what Trump said he wanted, and then what he thought he could accomplish. And I'll tell you, at one point I kept saying, well, if Trump gets what he wants in terms of putting middle America to work and doing all this stuff, then it's bad for the stock market. And the smartest guys, and they ended up being correct, but the smartest guys would say to me, but Kev, he doesn't really want to put middle America to work. He doesn't actually care. He cares about the stock market. And so far they've been absolutely correct, because I think most of the policies, you might argue, were designed very much for the stock market as opposed to middle America, right? Like even the tariffs, forget about whether he's tacoing or whatever, but if you just look at the trend of it, it just keeps going lower and lower and lower, like in terms of him amount that he's actually going and doing. So do you really believe in them or not? And like, what are you trying to accomplish? And I guess it's going to take middle America losing their jobs again, and like a little bit of an uptick in terms of a little bit of a recession scare. And then it'll be interesting to see what happens from there.
Yeah. I'm eager to see how the White House and just the GOP in general, like, handle like a bigger slowdown, and whether that's the economy itself or asset prices. If you go back to, the Liberation Day sell-off, first of all, a lot of that was really big because, Systematic was over its skis and had to kind of sell a bunch into that. So it made it look worse than it was in real life. But I think if you go back to that time, it looked like, hey, like the trade deficit is about to come in significantly. And that's bad for our market for the reasons you're talking about. But now, if you go look today, the trade deficit is bigger this year than it was last year.
I know.
So it's not surprising that our market's okay, and our market's not doing good. Like, you compare it to the rest of the world, it's not. But but still, you're up in the teens. It's a good year.
Yeah.
But a lot of that was because they backed off of the tariffs and let people front run the hell out of it with supply, right?
Right.
And I think as that starts, is we slowly have to chew through all of that inventory we plussed up and then go out and buy on this tariffed market. Like, then you see the trade deficit probably come back in. And I think that's when you see the market
interesting
with it. Right. So I think, it's weird, but like watching the seasonality chart of the deficit versus like the trailing year or two or whatever gets important, because I think it could melt about the same time. Now, but to your point, the chances of those effective tariffs staying as big as they are in the face of that start to look lower. It's funny because like one of the things I was arguing early on in that was like, I get some targeted strategic tariffs, like, sure, but like, why are we tariffing bananas and coffee? Like, this is insane.
Yeah.
So like, so far, all they've really done is take off stuff like that you can't even defend, right? But all these intermediate goods within the manufacturing process that are getting tariffed, like, that's the dumbest tariffs. That's dumber than tariffing.
Like aluminum. Like, what you're tariffing aluminum. It's not like you're going to make another aluminum plant. It's not like
right. And Alcoa has them all cheap energy in Canada. Like, this just makes sense, man.
I'd love to hear what you're thinking in terms of the K-shaped economy, like the haves and haves not, and what you're experiencing. You live in Seattle, and just what you're seeing with your clients, your people around you, and whether you think that K is getting more extreme.
Without question, it is. And I think really since 2020, it's just gotten worse and worse. And if you plug into the Mike Green piece, that is all anyone's talking about these days, talking about, the new poverty line. One of the most important things in that piece he wrote to me was the fact that he talked about how during COVID, like the working class, middle class, like, actually got a break and felt like they were doing okay again, because so many of their expenses got canceled and they were making more money. So, things like, obviously, like childcare, transportation costs just went to virtually zero. So all of a sudden, the American dream kind of felt real. So then you you turn the economy back on and you turn off that, and people have to go back to work and they have to get the childcare back, and the money supply is 40% higher, and so things all of a sudden are like 20% higher. Housing is 40% higher. Like, to have like this slice of a dream for a year, and then to come out of that and wake up back into this nightmare of 9% inflation, that was brutal. So I think a lot of people struggled with the fact that the top-down aggregates of the macroeconomy look good. Like that last 2 years of Biden, you're just like, what are these people sad about? Look, unemployment's 4%, and like, real wages are great. And like, then you're like, okay, yeah, but let's back out 5 years and look at what happened to real people here. So now you look at manufacturing jobs. We're down like 60, 70,000 manufacturing jobs this year because, as it turns out, tariffs aren't that helpful. So if you look at stuff like that, like real people are losing real breadwinning type jobs in places like manufacturing, construction. So I think the struggle is very, very real for the bottom of the K. And I think because the aggregates add up to being fine, so like all the policy nerds or whatever in DC and New York and stuff, like you just get the data on your terminal and you're like, yeah, everything's still good. Yeah. But the reality is, tens, if not hundreds of millions of people are struggling to just make ends meet. I think one of the things to watch here is that like the credit score averages, that's starting to melt. And that's very bad news. And as our buddy Paolo has highlighted well, the student loan payments coming back, and the fact that they just snatch it from your check. It's not like you get to pick and choose whether you pay that one. Like, it's just coming out of your check. That's a huge deal. And then we still have the sticker shock that's going to come with health insurance costs because of the Obamacare subsidies running off. So early 2026, if the GOP doesn't find a way to extend that stuff, you get another sticker shock that really smashes, the bottom of the K. So I think you're going to see that. And I think that's why a lot of like mid to low end restaurants and stuff are starting to see some struggles. And I expect, some of the like just normal retail stuff that we expect to do well to just get hammered. Like you see it, it's kind of an obvious way to look at it, but like a Starbucks where, does it make sense for a working class person to get like a $6 coffee or $7 coffee? Like, obviously not, but I think that's why they have struggled. Like, and I think, the Netflixes of the world could see some pain from that if people have to cancel, what is like a borderline utility cost for all of us now. But
do you think it drags the entire U.S. economy into a recession? Because like that's the problem, right? Like, it's definitely destabilizing.
If you asked me 9 months ago, I would say no. And because of the purchasing power of the top is so massive that I was like, they can just overcome like a total like destruction of the bottom 50%. But the more time has gone on, the more I've started to come around to thinking that actually this could actually become a big enough deal. It's so easy to view all this stuff linearly. It's just like the way construction itself can end up leading to a recession, even though it's a tiny sliver of the economy and of employment, because all the ripple effects from it. And I think you can have the same thing from the bottom floating up. Like, if enough stuff at the bottom has stress, it will ripple up, So I do think it's possible. Obviously, if you look currently, there's no significant signs of imminent recession or one coming soon. But at the same time, you can argue a lot of that tariff stress hasn't even really been felt yet because of like the intermediate stuff I was talking about. Like, so I do think it's possible, but I still think you really need prices in the market down to hurt the top enough to make them contribute to a recession. I really do think it's a tail wag the dog thing where the markets will decide a recession, not the other way around. So,
you're in Cuppy's camp. Cuppy says in the old days, yeah. What was his line?
Look at
the old days, recessions caused the stocks to go down, and now stocks going down cause recessions.
Him and I have talked about that, and I'm totally on board. If you look at like market cap as a percent of the economy and of household wealth and everything, it's so dramatically higher than it used to be. It's, if you do the math on like a 20% drawdown today, it's like an 80% drawdown like 30 years ago as far as what it does to households. So, I mean, if you got a real drawdown and it lasted for more than a V-shaped 2 months or whatever, like people would, you would have a recession, no doubt in my mind.
Okay. All right. I'd love to talk to you about this all day, but we got to call it wrap this up. So but let's leave on a happy note. Let's talk about your desert island trader picks. And for those who don't know, we ask all of our guests to come up with 3 bands that they would like to listen to if they were stuck on a desert island, and then 1 trader. So let's start with your 3 bands that you would love to hear on the desert island.
So I'm a country boy from rural Texas. So I'm a huge fan of Turnpike Troubadours, which is a red dirt country band. Probably like 9 listeners will know. Although I will say, for anybody that watches Landman out there, or like any of the Taylor Sheridan like cowboy shows, you'll have heard them on his shows.
Okay.
And because I went to college in Houston, I was a big Houston hip hop fan, so I will go with Paul Wall for my Houston hip hop. And I think Kev's gonna have to look all these up after we're done.
I am. I don't recognize a single one so far. So let's hope for the 3rd.
And I like the classical violin stuff a lot, so I'll go with Bach. So it's a Bach album to listen to some violin,
some hip hop and some Bach. Do you feel like hip hop or Bach today? That's what
maybe put them
very
together.
Contrarian views from you there, Chase. Not surprised in the least. All right, and what about your trader that you would be stuck on this island with to help you out and to manage the ins and outs of the market?
So I had one in mind, and then in the middle of our conversation, I realized there's another one, if not taken. I assume he's taken. Is Munger? Did someone take Munger already?
No.
All right,
nobody is taking Munger.
So the guy gets no respect from. Now, Warren gave him all the respect in the world, but from the outside world, everyone just talks about Buffett like he did it all himself.
Yeah.
And I think
Charlie
Munger
Munger
had more to do with it than we all think. Buffett called him the architect.
So I don't disagree with you there that they were a great partnership, great team, and that he was kind of the somebody he could bounce ideas off of. And I completely agree. Great pick. All right. So before we let you go, let's find out more about your great letter. Where can people find that? Give us the whole spiel.
Yep. So everything I do, you can find on pineconemacro.com. Like I still do my old school letters, which is like a PDF and everything. And I have 2 of those, but I'm on Substack, where I offer a piece of that letter it's like a funnel, essentially, a piece of that letter for a lower price. And then I also have a new Substack that started earlier this year. I call PMR Passport. And that is all focused on country ETFs. So I thought as we came into this year, we were finally in that spot where the rest of the world could outperform the US. So I decided to write a letter, and I keep up with news and data and everything from around the world. And I have a portfolio on there. It's always 10 country ETFs at 10% each, to kind of keep track of. Honestly, I did it for me. I did it for me to keep track of all these country ETFs to see who's doing well and around the world, because it makes me pay a lot more attention to it all.
Okay, so Pinecone Macro, and then so you go there, and there's different letters, and there's a Substack, and then there's the country ETF. What's the country ETF letter called?
It's called the PMR Substack.
PMR
Passport.
PMR Passport.
Yeah, and all that stuff is on the website.
You should be able to pitch your own thing without forgetting. And listen, let's take this moment to you and Zach. Your partner there at Bulwark. You guys have a podcast. Why don't you tell us about your podcast? And also, are you allowed to talk about Bulwark and like give them a little plug? Yeah, I think you are. Go ahead.
Yeah. So Zach and he's the founder of Bulwark Capital. We do a show called Know Your Risk podcast, and it's like a daily thing we do almost every day. We just tape it after the close. We literally do zero prep for it. It's just we just start talking about the market. Yeah, we just do a recap of the markets and talk about whatever. And then sometimes we'll have guests on like you've been on before. So we have guests on here and there to get into stuff. So one's
Know Your Risk, and then you guys are a traditional financial firm.
We're RIA firm, so a lot of retirement money and just. So do you take money from everywhere, or is it just mostly Washington area? No, so it started as basically Seattle centric, but now we have clients almost every state in the country now. We just passed 600 million in active management today, as a matter of fact. So
congratulations. Well, there you go. So if you are interested in looking for a new RIA, give Chase and Zach a call at Bulwark. If you love this terrific sort of research, go to Pinecone Macro Research, and you can learn more about why Bach and hip hop go together. Chase, it's always a pleasure chatting with you. I really thank you for your time, and go aluminum, go.
Yes, absolutely. And not aluminium for those.
That's right. Thanks again, buddy. Take care.
Cheers.
All right, Patrick, what do you got for us in Talking Charts?
All right, Kev, let's dive into it, and how things have changed in a week, right?
Yeah.
We were, or 2 weeks, like since the last episode, but I mean, we were talking about the vulnerability of the market, the breadth deteriorating, all of the kind of CTA triggers that were lying below. The market comes in, has a very typical market correction, and snaps back like an elastic band, just right back toward the 52-week highs. So I wanted to take a moment to kind of size up what we saw. First of all, for months, I kept sounding like a broken record. This has been the longest market rally and the largest in duration without a 5% market correction. It was 100th percentile in terms of that. I kept saying that over again.
By the way, everyone loved your talking like last week's or 2 weeks ago, the no guest episode where we really got immersed in the Talking Charts section of Patrick. But one of the things that folks did take away from that was that 5% correction, and literally it happened like the next day or like within 2 days, right?
And so here we got a 6% correction, so it's in the bag. So so based on that criteria, which is 4 times a year on average since 2020, about 4 times a year, there are these 5+% market corrections. This 100% qualifies that and resets it. We can't no longer talk about a market that hasn't had a 5% correction because it's happened.
Okay.
And so now the question is, what's in store for the market from here? Now, there's 2 scenarios. One is that this is playing out along the analog from what happened right before Liberation Day. So if you remember last year, going from Christmas into the first weeks of January, we had a very turbulent time. A market was selling off for about a month. It spent a week or more trading below its 50-day moving average. From peak to trough during that period was about a 5.6% correction, very similar on a percentage basis in terms of the magnitude of the correction. And even if you look like things like the breadth of the market right here, what you can observe is during that sell-off in December, we saw a pretty serious deterioration in breadth, even though the market never had much more than a 5% drop. And so we had this correction. And look at the rally that followed in the 7-8 days that followed. It was just a rapid snapback rally that ripped the market for a direct double top retest of the market. And what is crazy is that this actually mirrors and this very, very closely. In a sense that we had this kind of like 1 month correction off of the highs. It's been about a 6% correction and a pretty distinct kind of snapback rally that's basically got it back to the highs. So this is as a technician, this is a question then to ask is like, are we still in the midst of a topping formation where this becomes a technical double top? Or do we see a temporary break to a higher high to print 7,000 where we see the head of a head and shoulders pattern, some broader topping formation that takes us into January? Or was this enough to be a midpoint and we're having another full bull leg higher from here? Like, this is the puzzle to solve. At this moment, I'm not ready to abandon the view that, in fact, I still want to give more benefit than not that this is a broader topping formation or distribution cycle that's starting. But we have to weigh the scenarios as to, well, what if the bulls actually get this one right, and that there's another leg. And so let's actually dig deeper into what are the different things that we would see under the different scenarios. Well, one, if this market is going to go through a distribution cycle, this market should not make much more progress than 7,000. Now, the fact that we haven't printed 7,000, I still actually think at this moment it's realistic. The market tends to gravitate to round numbers. It's a great sensational headline for CNBC and other places to kind of like do a bull victory lap. So a market that prairie dogs the previous high and rips to 7,000 to create the head and shoulders pattern is totally within a broader distribution cycle kind of framework. And so at this moment, I won't rule out that hit to 7,000, and that's on the cash index, which is still over 100 S&P points away. We're at 6850 on the cash index. So if though that this is a topping formation, if this is still a market that is going to be heavy up here and something's going to break in January for another leg down, we should see a lot of the things we've been talking about last episode persist, which is the breadth of the market, while it snapped back here, shouldn't make much progress beyond going to like 50 to 60% on the upside. We should see that divergent behavior in things like financials and potentially things like junk bonds should not make higher highs. We should see price action that generally is saying that, well, look, the market snapped back, but nothing really changed. Right? Like if we see that, then that continues to be supportive of the idea that this market is just challenging those people that got short really early. It's funny, like from a perspective of like when a market finally breaks, it's usually after people give up on trying to hedge it. Like when it's we're in a scenario where everybody was getting very well prepared for an inevitable correction, and it seemed like that too many people knew exactly how they were going to play it out, including myself. If I thought it was going to be deeper. I thought it was going to go farther, and it didn't. Right, and I was prepared for a 10+% correction, and just never materialized.
The jokes almost write themselves there, Patrick. I won't say it. Anyways,
okay,
keep
perfect.
going.
No problem. Thanks for the jab. So nonetheless, we have an S&P that's coming up towards its highs. One thing that I think will be a huge tell is going to be the semiconductors. Now, NVIDIA particularly is still trading below its 50-day moving average, and has not participated at all in the recent rally. Right now, while that's the case, I do want to highlight the SMH semiconductor ETF has actually behaved better. You're seeing a scenario where this descending trend line has already been broken the upside, got back above its 50-day moving average, and did find support exactly at the 61.8 retracement, like Fibonacci's work. And basically it bounced off of that zone. So if we see a scenario where semiconductors resume, like for instance the AMDs, the Intels, all of the Taiwan semiconductors, if we see that they can actually break out after a retracement like this, then the entire bull leg might have still another push into January. And so watching whether or not the semiconductors can beat some of these key technical levels, I think is going to be critical. It's certainly one of the things to watch. You want to comment in there before I go on?
No, it's some great stuff. I completely agree. I think that it's a great kind of take you have, but I would just kind of, when you said something about Fibonacci is working, I felt like pulling up this tweet from Investing with Brandon. Is he a big deal?
Okay.
I'm not sure. He says, I got over Guy says I have over $2 million in the stock market in VU and QQQs. And then this is where it's kind of funny. He says that will average 12% annually. That I'll make $240K a year for doing nothing. I'm glad he's so confident that that's going to average 12% annually. Like, why not even more? That doesn't even count for the 25 grand he makes with options. And I'm wondering if is that selling like Mag 7 puts? And then the part that I thought was like, I feel like, he really saw us, was that he says, Fibonacci that.
I'm going to steal that line. It's like
Fibonacci
hit
that.
You hit the 61.8 retracement. Fibonacci that, buddy.
Yeah, there you go. That's going to be your new tagline from Investing with Brandon.
All right.
Fibonacci that. All right.
So a couple of things to highlight. So one of the other hot stocks within other than NVIDIA was Palantir, and also quite a laggard. So it's interesting how almost like the baton has been passed in the Mag 7 space away from the two really hot names, which were Palantir and NVIDIA for the longest time, and they're now lagging. And we see other Mag 7s working. So let's go through all the Mag 7s. Let's actually go in order, because one of the strongest has been by far Google. And Google did this little flagging formation during that entire corrective phase, barely budged $10 off of its high, and then blasted out of this flagging formation with a bull continuation pattern to the upside. And these different measured moves are all the way up to like $350 from this. 350 is the measured move. So like what's happened is that the NVIDIA's kind of stalled out, but suddenly step into the ring was Google with some new found momentum. And the other one that had a nice breakout was Apple. And even Apple just broke out towards attempting a 52-week high like it wants to go. And so some of these secondary, not secondary, but the other Mag 7s are kind of picking up the slack for NVIDIA on the very short term.
Yeah, completely agree. And there's that great chart by Kotu. If you don't know, Google it. And he had the Google complex versus the OpenAI complex, and he kind of made a group of different stocks. And it showed how over the last, month or two, they've just diverged. They've completely gone separate directions. And I would almost say that part of the Google strength is the opposite mirror side of the NVIDIA weakness, meaning that people are switching.
Pivoting.
Yeah.
So now what's interesting, let's go through it. So Meta was super oversold, finally getting a little bit of a bounce. It's going to be important to see whether Meta fails at its 50-day moving average and stays in its primary downtrend. I would be betting yes, but it certainly can muster up another $20 to $40 on the upside on the short term. So I'm not already like leaning short. I don't have any shorts on it, but this is not one that I would be a high conviction to be buying long. I think there's better Mag 7s that are doing better right now. But Microsoft, after putting in a double top and breaking the neckline of its consolidation zone, basically did a 38% retracement, didn't even make it down to the 50% retracement. Also coming back to a pretty critical level, which is this where the 50-day moving average is where all of the consolidation lows are. So as we approach that $510 area on Microsoft, it's going to be a really important tell as to whether its correction is over or whether this is just a very oversold bounce. And it, like Meta, it might be vulnerable for turning down and continuing its sell cycle. And so, others like when you look at Tesla, Tesla actually held its retracement to a 50% retracement, getting back above the 50-day looks a little bit better than some of the others, and maybe it might join the party. And of course, then there's Amazon, and Amazon. I'm a little bit neutral here. I don't want to say anything positive, but I don't want to say negative either. It is always disappointing for the bulls when the entire previous rally is completely wiped out. So usually what you want to see is the stock doing a dance where it goes 2 steps forward, 1 step back, 2 steps forward, 1 step back. You want to see it always being well accumulated on pullbacks, staying above moving averages, showing good price action and accumulation patterns, right? And when you see where it takes 2 steps forward and takes 2 steps back, something usually means that there's some more active distribution and definitely a pivot in momentum and flows and all sorts of other elements. So to me, the fact that Amazon's bouncing, well, it was quite oversold, but it's not that impressive, its bounce. I would put this in the same category right now as Microsoft and Meta, in that this is not likely where you want to be. When, like, I was actually quite bullish on Amazon when it gapped higher, but it needed to stay at 52-week highs, or at least above these consolidation levels, in order for that bull momentum to continue, and it completely stalled out with this correction.
All right.
The other thing I want to highlight is just touch on Kospi, right? Remember, we talked about this being the
new Korean stock index trader.
The South Korean index. But what's interesting is, very much like Nvidia, it's really not done anything in the last couple of weeks, or at least the last week when this bounce has been going on. Now, this was one of the hottest stocks. Samsung and the others in this index were ripping to the upside. They have generally stalled out here. So what will be, again, a sign as to whether the market is heavy or not is, will we see the Mag 7s all start to run? Like, will we see them all trying to turn up here and go farther? Or are we going to have the same situation where only like Google and Apple are working, and suddenly all the other Mag 7s are still kind of chewed up in trade ranges and not able to make higher highs or push any key technical levels? That would be a huge drag in general on the Mags if we see that. And so
what would be amazing, Patrick, is if this already narrow market got even narrower.
But the question is that if Nvidia isn't ripping, then which mega cap is going to be able to run the narrower and actually push new highs on the index? I mean, it could be a combination of the other Mag 7s, but there's going to need to be more than one of them. It's going to have to be like a 3 or 4 of the Mag 7s that are kind of all tied to the wagon and pulling it higher, right? Like it's not going to be able to be Google alone. Just looking at some of the secondary markets, I'll be watching definitely whether or not the high yield market, the junk bonds, can actually bust to higher highs. Now, they came off the edge of the cliff. They were below the 50-day. They were trading along their lows. This was a huge danger point if we saw the break, and they never broke down. So they were not at any point giving a big negative sell signal on that front. Another interesting thing, we talked about the equal weight S&P, and this is particularly interesting. Look at the robust recovery of the equal weight S&P. Now, while we did see a good snapback in the breadth of the market using that 50-day moving average chart I showed earlier, it is impressive the way that the equal weight index recovered as rapidly as it is. And this would be interesting, because if this thing maintains that momentum, what we could be seeing is the sector rotation, where the question, of course, is that will that stall out the S&P? Will we see a window where the equal weight will actually outperform the market cap weighted, because everyone is reshuffling their weightings into those Mag 7s and redistributing it amongst the cheaper parts of the S&P?
So I got a view there. Yes. And in fact, I think that smalls are going to be bid as well into year end. I think this is going to be the surprise that no one's looking for. Everyone's stuffed to the gills with Mag 7, thinking that those are going to rally into year end. I think that what'll catch a lot of folks off guard is the stuff that rallies into year end. It's not going to be what you think.
Well, this will be interesting, because look at the small caps. They made a pretty violent recovery as well, almost right back to their highs. And so it would be interesting to see if we see that rotation. Now, overall, I think that will be a huge drag on the main S&P, because the market cap weighting of these behemoths is so huge that if they're being distributed, it is going to be very hard for the S&P to make any progress.
But it'll be great for those who want to trade different names. So you're right.
Yes.
Maybe S&P goes nowhere. Maybe it chops around, everyone gets confused, and it frustrates the bulls and the bears. And then in the meantime, like smalls and mid cap and even the equal weight is flying. Right.
Well,
like that.
An example of that is rotation into, for instance, look at the way that money rotated into healthcare. Everyone murdered this on that Maha was going to kill the profits of all these pharmas, and they're back to 52-week highs. Completely brushed that off. We then,
and by the way, for those who aren't subscribers to Big Picture Trading, that was one of the calls. Yes, and while we're making shameless plugs, Daniel's told me that I got to plug your YouTube channel because he has a goal. It's not Patrick's goal. He's just a very humble guy. But Daniel's got a goal of 20,000 YouTube subscribers, and he wants, to get there before year end. So go subscribe to Patrick's YouTube channel. Help Daniel out.
In the description below, you can click on the link. Yeah. Danny will include it just so that there's impossible.
And Patrick has promised us that he's got less cigar smoking, more charts.
Yes, absolutely.
Yeah.
All right. So another example is the energy sector, and what you can see here is that it defended the 50-day moving average, which was more or less just a retracement of its prior rise. And it may very well attempt to break out here. And so what if that sector rotation finds these energy names? They're actually all behaving pretty interestingly. And we can go through some of the names in a little bit more detail here in a moment. But the interesting idea is maybe the mags don't rip, and maybe we have some of these other sub-indices start really going, something like consumer staples. Well, look, consumer staples were in a huge bear market not bear. Well, it was pretty ugly couple months we went from an August high to a November low of a 10% correction. So I wouldn't call that a nasty bear market. It was a correction, but it was still counter to the rest of the markets. And look at the way that it's recovered here in the last week, right? Or last even month. And so the question becomes, are we seeing that rotation? Are we going to see some of these sub indices that or sectors, that underperformed now actually get a whack of money rotating into them? And that's, again, something you just said was a part of your thesis. The question I have for you is, other than the ones I mentioned, is there another sector you think we could look at that might be taking some of this flow?
Well, I think the XBIs as well is another part that you might want to look at.
Well, yeah, but these things have already been running.
I guess so, but they feel like that's a big sector that can take some more money.
Yeah,
there's,
but that's all consumer defensive, right? Versus cyclical, right? You're talking pharma. How are the utilities? XLU, utilities. Look at this. This could be a scenario. This could be a scenario where we have a 50% retracement, held the 50-day moving average, and suddenly this thing could break out for another full run on the upside. Maybe all of these very stable kind of names may very well actually all get a new wave of buying.
Can we backtrack a little bit to the point where you talk about this snapback rally and what caused it? Because I do have a theory, and it's actually one of my buddies on my trading desk, highlighted this to me. And when he said it, I went and looked at it. I think that this really was kicked into high gear when Hassett was floated as the front runner of the Fed. And if you pull up the poly market Hassett odds, you'll see that they went from 15% to 55%, right, and that coincided with the stock market taking off. so that also could explain why small caps are doing so well, because small caps should theoretically be more sensitive to interest rates. Yeah. So what worries me about this rally is that if it is the case that this is just the market front running an irresponsible Fed, it's not really the stuff of fundamental good, buying reasons, right? And that does concern me. And not only that, I'm not as sure that even if you do get Kevin Hassett as the Fed chair, that the Fed is all just going to go along with it, right? Like I think this is a lot more complicated than the market believes. Right. And that it's not as easy to get in there and just, cut rates 100 basis points or 200 basis points. But it'll be interesting to see. But I do just want to throw that out there, that I think that at least part of the reason for this rally was this Fed, floating the idea of Kevin Hassett. And given the market's response, I suspect that he will get it. And I've always said he's going to get it, like in terms of, I thought that it wouldn't be a traditional person that wasn't going to be loyal to Trump. If you go look at all of the people that Trump chooses, above all else, it's loyalty. And to me, Rick Reeder, although Wall Street might like him, I'm not sure that he's going to, Trump is going to feel like this guy's going to do what he wants me to do. Like when we look at, he chose Powell, right? Like Cohen convinced him to, in the previous administration to choose Powell, and said that, this would be the choice that Wall Street liked and the best decision. And he, within a year, he hated it and was, screaming about how the guy couldn't putt. And he's like probably one of his biggest regrets, right? And so I don't think he's going to do somebody that is what traditionally Wall Street would like. He's going to choose the most unorthodox person out there. And I think that's Kevin Hassett.
Kev, that's a great point. And the interesting thing, and I'd love to get your brain, pick your brain on this. Like we have basically now the market gone from like dropping the odds of a rate cut in December down to, it was like 25 or 30% at one point. And now it's back to 87%. Like the market has now put it back in. We saw that kind of drop and pop on the odds, but still in general on that rate cut odds, we haven't seen the December 2026 budge. Basically, the market isn't really in any way pricing in a big dovish pivot. And yet we do have some form of a change in governance coming in the FOMC committee in the new year. And how do you size this up? Do you if we get one of these Fed governors coming in there that is going to be dovish, like how dovish could dovish be, and when will the market start to actually bake it in?
Okay, so first of all, you're absolutely correct to highlight how the market went from what was it, 50-50, and then it went all the way down to 25 or 15% chance of a cut, meaning that they gone, and it was after the FOMC. Remember, we had that FOMC last period. Powell came out, he was very hawkish. It really took the wind out of the sails in terms of expecting another cut, and the market backed up on that in terms of the front end. It also, drove down risk assets. And then what happened was, about a week ago, there was a couple of Fed governors that changed their opinion. And most importantly, John Williams, I think it says John Williams. Anyways, Williams came out, and Williams is the Fed president, governor, I can never remember which is which, for the New York Fed. And one of the things that you need to remember when you're watching FOMC and watching the Fed and trying to read the tea leaves is that not all the FOMC members are equal, right? Yeah. If you get some, St. Louis guy saying something, it's not that it's not important, but it's not as important as one of the big three. And who are one of the big three? They are the chair, the vice chair, and then the New York Fed president. And that is important. So when Williams came out and he changed guidance, he was the one who moved the market. And he wouldn't have done that unless Powell and him, I suspect, had made a plan. So my guess is that what happened was they decided they were going to do one last cut. And part of the reason that the reason I bring this up is because you're highlighting that the December 2026 isn't moving. And because to me, it feels like they're going to do a hawkish cut, meaning they do a one and done. They're going to come out and say, okay, we're going to do one last cut, and then we're going to watch and see how it all evolves.
Yeah, but you think they would do that right before the jobs numbers are going to be released?
I think they would. I think, first of all, if the market's at 83%, they've purposely put it there, and the Fed has never, ever, like in the last 30 years, gone against the market. Now, you could say that they will come and move it back, but right now, as it stands, it looks to me like there's going to be a cut. And how I interpret it is it's going to be a hawkish cut. It'll be like okay, we're going to do one last one, and then we're going to see how it plays out from there, and we're going to wait. Well, now the real question is, how does the market react to that?
Well, look, okay, let's look at it from a probabilities perspective based on just what I'm seeing here on the screens, right?
Yeah.
So the January meeting, the belly of the curve is that they don't do anything. All right, so that they're going to stay.
That's not the belly, by the way. The belly's in fives. But anyways, so the next part of the curve, I just want to make sure we're trying to get our stir cred here, Patrick. Okay. So we got to be correct.
Okay.
Yeah.
All right. So the point though is that they're not pricing in a cut for January.
Correct. Okay, which is what I'm arguing.
Right.
That the market is priced
as well. That while they're much more equal, but you can see that the odds are actually greater that they again don't move in March, even though there are almost a 40% odds that they might cut again in March. When you go to April, that's where they're pricing in one more cut.
Yeah.
So they
for a little while.
Yeah. And so, but the market is already pricing that somewhat in. And so the question is,
so one second, Patrick, because
do you think that would surprise the market here?
So one of the things that I have found over my years of watching the Fed and then talking to stir traders and then watching how the equities react to it, it's shocking to me how the two camps don't listen to each other. Like the stir guys will be like, of course. And they'll be like, yeah, of course they're not, they're on hold. And this is so obvious. And they'll be, their market won't move. And then meanwhile, equities will be losing their shit because they've all, passed around, on Twitter, the thing about how we're going into the biggest cutting cycle ever and blah, 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 blah. And then they're taken aback. So I really truly think that, yes, you can look at those numbers to ask what the stir traders have priced in, but that's not necessarily what the equity traders have priced in. So right. I would contend that most equity traders will be surprised if Powell does a hawkish one and done, right? Like if he cuts rates and then he says we're not going to cut rates for a while. I think that the market would be surprised.
Okay.
Like the equity market, the bond market's going to be fine with it. And in fact, I think the bond market might like that because, again, at least on the long end of the bond market, the thing that you are worried about the most as a long bond investor is an irresponsible Fed that creates too much inflation. So if the Fed was to show responsibility and to do the correct thing and, safeguard the purchasing power of the dollar, you could actually see a situation where the curve flattens, not steepens.
So I'm gonna now attempt to make the hair on the back of your neck stand up a little bit and talk about how actually the price action on the 10 and the 30 year is actually behaving very well, like bonds are ready to go.
Yeah, well, and that would be I don't think that there's anything that's not in terms of what Powell's doing and how if the Fed is more hawkish, that there's no reason why that can't be the case.
Right. Okay,
so give us the technical picture.
But the point here is that every time it's sold off right back to highs, we're at the 4% yield basically on the 10-year yield. And I think it's a psychological level because once we're below 4% on a sustained basis, that in itself could create just a psychological kind of additional pivot to kind of cause some additional money flows to come in there. But you could see that the 10-year yields are right, or yields, the 10-year bond is right up along its high. And even when you look at the 30-year bond, it got bought on dip. It's back above its 50-day moving average. It's not as strong as the 10-year highlight. It's the 10-year is stronger for sure, but the 30-year might go. And so watching closely whether these bonds continue to behave well.
Yeah, listen, I'm not. You know me. I've given up on my hugely bearish bond view.
At least for the short term.
Yeah, it's like you with the U.S. dollar. You have your bias that you love to buy it in a risk off situation. I love to sell me some bonds. I think that they're a useless instrument that's going to lose money over time. But eventually,
well, let's talk about
one second.
dollar.
At some point, there will be tons of term premium in them. They will offer huge real yields that are positive, and I will like bonds again. But it's going to be a long time. And and you know what? I'll highlight one thing. I remember my best friend was way back when, and you're going to laugh at this story, Patrick, because my best friend way back when would this be? This would have been 2005, 6, somewhere around then. He was asking me, he was leaving his company and he was going to work for himself, and he was looking at creating a portfolio. And at the time, so this is 2005, so we haven't yet had the GFC. And at the time, he said to me, and he was very much a student of MBA, like the MBA School of Thought. He says, "Well, if stocks provide superior return over the long run, and I'm young, why wouldn't I, just be 100% stocks?" And I just laughed. I was like, because there's going to reach a point where you're going to be tested. It's going to be ugly, and you want the bonds, for that income. And I used to love bonds back in 2005. They were terrific, and they were unbelievable at providing a ballast for your portfolio. The real problem was that they got priced too stupid, and they were, and not only that, the world changed, and now we have fiscal everywhere. So I still think that over the long run, bonds are a dumb bet.
Absolutely. We saw negative interest rates, and then people throw out century bonds and shit like this. So inevitably, there had to be some sort of back to reality from all of that.
Anyway, all right, what do you got?
Let's go on. We gotta talk dollar quickly.
Of course,
dollar's testing a key level along its 50-day moving average. I want to highlight a couple of things. First of all, the U.S. dollar yen already had a good run. Right. And so it's stalling out a long overhead resistance, which is something you would have expected after finishing a technical measured move up to its previous highs. You have a scenario where at least it's supposed to take a break technically, just as resistance becomes meaningful. And there could maybe be some sort of intervention to stabilize the yen or something that's happening at these kind of upper levels. So the point being, in order for the US dollar now to break out, it's not going to be able to be the yen that's going to do it. Now, it's going to need the breakdown of the euro. And the euro is toying with this 50-day moving average. And it's been very weak, but yet not breaking any technical levels. And one of the puzzles to solve here for us technically is the next major move on the euro down or up? Because that's going to decide everything. And overall, the distribution of the euro continues, but this 50-day moving average is going to be important, because ultimately the entire last 2-month correction has the 50-day moving average has rejected the euro every single time. And so if we see any technical breakout above there, that could stall out the entire US dollar rally. This is, I think, important, because a part of my risk off narrative was that the US dollar was going to be a disruptor in the reflation trade stocks and story that was there. But if for whatever reason the euro doesn't break down, well, it doesn't necessarily make it a big US dollar bear market leg coming, but it would basically muddle the currencies up for maybe a month or a quarter, and allow the existing reflation trade stories to really perpetuate, maybe even another major leg up in commodities if that was it acted like a tailwind. So watching which way this breaks, I feel is going to be pretty important.
I'm with you, Patrick, but and I do think that I was listening to Mark Cudmore from Bloomberg on Bloomberg this morning, and he was talking about how we I've seen dollar strength because of a U.S. company bringing back money for CapEx. And I was like, oh, that makes a lot of sense. And I think that we've also, the point that he missed is that I think there's also been a lot of money coming into the U.S. to buy stocks, to buy the AI bubble. And one of his arguments was that in the new year, this is going to turn. And I was like, oh, you know what? He's probably right. And I thought that was a really well laid out thought process. And I suspect that it's too early to get too bearish on the US dollar. But I think in the new year, it's going to be time to lean into the pink tickets again.
All right. Now let's talk about what I actually think is really worth noting here. And that is the fact that precious metals are suddenly buzzing. Now, what's interesting is gold still has not yet beat its October high. But the interesting part, so one of the things I've been highlighting, right, was that gold has that 4 past corrections on gold lasted anywhere from 2 months to 4 months before gold was able to break to a 52-week high and resume its bull phase. We're right now 40 days into a correction, but by all accounts, a 30-day market correction is more than sufficient to have unwound the overbought state of an asset after a bull run. So it could just be that this is going to end up being the shortest correction out of the last 5. Okay. Like, you know, like it's not just because the other ones were 2 to 4 months doesn't mean this one can't be 30 or 40 days. And so the question here is that, is this breakout in gold going to happen? Is this real? But there's 2 things that make it particularly interesting. Number one, silver just blasted off like it stole something and is running. It's running. And like, what a breakout, Kev.
You know, this morning, one of my buddies said to me, oh, a triple top in the silver. And I said, what did I say?
What did you say? There's no such thing as a triple top.
There you go. It proved again.
So this puts in play a target on silver up in the $60 to $62 range. And so silver just broke out and it's running. The question is that bring enough attention back to the entire precious metals complex to just get everything going again? And that's the puzzle to solve. So gold itself hasn't broken out above that high, a November high yet. But you know what? You look, gold miners have just broken out their November high and are making a full run at their previous high. So like gold miners might be ready to go for another punch up towards even 90 to 100 if they really get going here. And then when you look at the other precious metals, while platinum and palladium have not really yet fully participated, you can see it was a classic 50% retracement, like Fibonacci's actually work. Or what was the line? It was
Fibonacci that.
Yeah, Fibonacci that, a perfect 50% retracement. And so you have a clear breakout. And like this could send platinum up to 18 to 1900 on this impulse. You take palladium is going to give a stab on breaking the descending trend line, and Fibonacci that 50% retracement to the 50-day moving average, right? Like look at it. So it's almost like Fibonacci's work. No, but like in the end, the point here is that we may actually have a breakout in the entire precious metals complex.
Yeah. My real question though is what worries me is it happening because of Kevin Hassett? And I don't know. Like, is it just an illiquid worry about Kevin Hassett and they're just running these things, or is it the real thing? I don't know. You know me, I'm a bull, so I'm not
Well,
upset about it.
well,
But
look, a real thing or not real thing, there's going to be some sort of a bull impulse. Maybe what happens is like silver runs to 60, but gold only double tops along its previous high. Like
yeah,
there could be a scenario where one is materially outperforming the other.
yeah,
Right. And they don't all have to be equal. But what I can tell you is that they all held retracement zones. They all held their moving averages. They've all been accumulated on every single dip. And there's money flowing in there, and they're being well accumulated. These are undeniable facts. And there's not really much you can argue on the bearish side other than they're already at elevated levels and they're high. Like that's your only argument, is that maybe they're expensive at these levels, but that's all you can argue, because technically there's nothing you can say about their price action that's negative.
got it.
Right. So on on crude oil. Now, I was expecting the vulnerability that we could have a full double bottom retest again of that major support line at $56, $55, $56. But crude oil, for all of its negativity, could not muster up the weakness to break down all the way down there. And now I am not seeing yet bullish price action on crude where I want to say that this is the turn and this is definitely where it's going to go higher. But generally, along bottoming formations, there's divergent momentum where the sellers simply don't have enough to lean on to break it to lower lows. There's clearly some sort of accumulation that's defending a price level where it's basically oil's found a fair value zone where clearly supply and demand are reaching some sort of equilibrium. And when you're seeing the energy stocks behaving the way they are, I don't want to say I'm bullish oil as much as I think it's incredibly asymmetric to be long oil, because at this stage, I don't know how much further downside risk there is. And the upside is enormous if it turns. And so it's one of those kind of where value investors have to be looking at this, right? Where you're basically seeing things at a depressed lower level where that risk is probably very reasonably sized on the downside, and the upside is huge. And so I continue to watch whether energy is going to become the place to be.
I don't want to go trip.
The next topic. Just want to touch on, like, look at the way oil service stocks have been behaving. Flagging formation for bull continuation looks great. You take a look at the XOP, which is the Explorers, got bought on dip, trying to work its way right back to those highs. It will be interesting to see whether they can break out of this 6-month trade range to the upside. You know what? Energy is interesting. Now, the other one I wanted to touch on is the left for dead space of the ags. And Deere recently had its earnings. It kind of gapped down on its earnings, but the interesting thing that they said in their conference call was that they felt that there was going to be a major cyclical shift in 2026 for the entire ag space. And I thought that was interesting. And while the charts look absolutely vicious on these ag stocks, like this is Mosaic, I'm picking on one of the worst ones, which has been in a vicious bloodbath, almost halved again in the last 6 months. But at some point, these ag stocks have been bled out. Like I'm just going to pick on Nutrien for a moment and look at a weekly chart going back 3-4 years. Like go back to 2022, we went from $115 down to trading at like $40. Like this, we have seen a 3-year bloodletting in this space. And the bigger question here is that are we going to, in the new year, see the ag story come back in a big way? And like, will we see things like ags and energy become players back on the field versus everyone just cornering uranium and gold.
So, Patrick, you'll be pleased to know that I'm not with you on the ags. I'm not saying you're wrong. I'm just not as convinced as you are. I think that there's a lot more going on. It's difficult with
First
Trump.
of all, I am not
policies
making any technical call yet.
I know you're just watching it. I get it. I understand. I think it's going to be another period of yuckiness and not looking at it. Like, just it's not going to be good. But who knows? If it starts to perk its head up,
so I will say
you're going to be there to tell us. Look at the
weekly chart. Look at the weekly chart on Nutrien, and I just will highlight this. There was a 1 year basing formation developing. Made a higher high, and overall this entire consolidation held its 50-week moving average in what is like a typical flagging formation. While I'm not making the bull call yet, I will say if technically this thing breaks out of this little wedging formation with staying above its 50-week moving average and it breaks to higher highs, then it's happening much sooner than you're expecting.
Okay. I'm not gonna listen. I'm not saying you're wrong. I'm just
no. I'm just saying like that's the technical thing to watch. I'm just saying like it's not. It hasn't happened yet. I'm not trying to claim it is. I'm just saying that's the thing to watch. If that breakout happens, then it means that things are happening now as opposed to later, and you want to pay attention as to whether those ag stories have turned. The other thing to highlight is so uranium's been kind of a dead space. Particularly this is the Sprott physical. It's been kind of working off of its lows, but it hasn't really gained any traction. But what's interesting is when you look at the broader uranium space, we had this extraordinary bull run, right? Like this thing from its from its Liberation Day lows to peak was a 200% run, just insane. Right? Like an epic punch to the upside. But what's interesting about this correction is Fibonacci, that 50% retracement right here. Like it basically gave back 50% of the run, which is what we typically look for in a healthy correction. So for all of the bullishness that happened in uranium, this correction's been pretty violent. I mean, from peak to trough, this has been basically a 35% correction in uranium in basically less than 2 months. And so at this point, the question is that enough of a correction in what is a primary bull market?
Yes.
For this.
I'm going to answer it for you. Yes.
All right. I'm not going to say anything else because you're going to goocher it.
I'm going to goocher it. You're the one that sounds like you're also bullish.
I never said that. I said it'll be interesting to watch whether or not this level. I don't want to goocher it. So look, listen, everyone knows, all our listeners know what happened with this supposed stock market correction when you came on and said you were bearish and I said I'm bearish. And of course it didn't break down. So at this moment, I will not goocher it for uranium.
Fair enough. Understood. We're just looking out for our listeners.
Yeah, we're looking at
Patrick's indifferent to uranium.
I am not going to say it since you said bullish. I'm going to let you have this one, okay, buddy?
Okay.
This one's your call. Anyway, is there any other one? By the way,
it's been a long time, buddy. It's 58 minutes.
Thing I just want to touch is one thing. Okay. Argentina broke out on the elections. It did a direct
something really important that we have to talk about at the end.
Argentina, buddy. Just quickly, it pulled
huge
back.
Liquid market that everyone trades.
Absolutely.
Okay, what's going on with Argentina?
Hit the 50-day moving average on a retracement. Got bought on dip pretty quick. Argentina might be back in play. That's all I got, Kev.
There you go. All right. Okay. All right, everyone. Thanks for tuning in. Patrick, where can they find more about this sort of great hard-hitting analysis about other Latin American countries?
Well, before I pitch that, I got to say that Danny will be very happy if I basically push and say, come and check out my YouTube channel.
There we go.
Patrick_Ceresna.
There we go. And by the way, I found out that I didn't quite execute my plug as well as I should have. I was supposed to say, this is why I should write it down.
Let's get Danny on.
Yeah, I was supposed to say, it was 18,000 and we got to get 2,000 to get to 20. Although, Danny, that almost feels like it's so insurmountable that nobody's going to bother. They're going to be like, screw it. He's too far.
No, that's too far. No. We started in April at 5,000. You do the math.
You do the math. All right. Anyways, please help Danny out. Go to Patrick _Ceresna on YouTube and subscribe to get all this hard-hitting action. Patrick, why don't you tell us?
Kev, where can they find you?
They can go find me at macrotourist.com and listen. Bear market, bull market, where you're always happy to spend some time together on this great, wild, crazy ride. Now stick around for the after show. Okay, we got to do this beer.
Yeah.
It's got an unbelievably awesome kind of
logo.
Label. Like, it's just like, I don't know if you can see it. It's so good. It's such a great label. And it feels nice because it's not like smooth. It's like got a little bit of like when you feel it. But the beer is anything but smooth and anything.
Oh,
come on. It's terrible, Patrick. Like, it's just awful. Like, it's awful. I'm going to go like, I'm going to do, it's so bad. I'm going to do an amateur score 3.
Oh,
no, but that's you just insulting yourself. That's not even
so
doing
bad.
a disservice.
It tastes like I don't know. It's like you went and took some hard liquor, like just like moonshine, and like stuck it in with some barley and didn't bother doing anything with it and just like put them two together.
My friend, it's hops.
Okay, hold on. Wait,
yeah,
wait. I want to hear Pat's. You've made that point. Now, Pat, what do you give it?
Well, first of all, I'll have to admit that because of my geographical location, that I have generally had less exposure recently to IPAs. So this has been the first IPA I had in months. And so for me, I've loved IPAs in the past. So it was refreshing to come back to a beer that I haven't had. So to me, it was like seeing an old friend. And so I personally actually was pleasantly surprised by. I happen to though like IPAs. The biggest problem is, Kev, is you're a pale ale guy and you're like these higher percentage IPAs are not your thing. You just have to admit that the beer was going to get a bad score from you right from the beginning.
Okay, maybe I won't disagree. I won't disagree.
On that basis, it isn't the best IPA I ever had, but I am actually quite enjoying it. I enjoyed it so much I spilled it all over my computer.
Yeah.
But
I should have done that.
Yeah, you should. But I'm gonna give it a 7.9. I would drink this again, and I didn't have a problem.
Patrick, sold to you. Sold to you.
Go for
run
it.
across the pit. Sold. Okay, Danny, you're the tiebreaker.
Right. Okay. Well, Patrick walked on eggshells around that one. I noticed it took him a long time to give a score, but I'm not gonna beat around the bush. I thought it was really good. 8.6.
Oh my God! What is with you guys?
No, what is with you, Kevin?
You're not
what is with you,
chain?
Kevin?
You're not yanking my chain. You actually like this beer?
Yeah, 8.6. Yeah. It's like a wine. It's great.
Christ. Okay, well, I'm just showing my Gen X-ness and like hating all these.
There's no Gen X. I'm Gen X too, buddy.
You're not really. You're almost a millennial, buddy.
Oh, come on.
You take pictures of your food. You have, like all this stuff. You are a millennial. You're a Gen X that wants to be a millennial.
I am Gen X, buddy. I rode a BMX bike my entire childhood.
Patrick, do you take pictures of your food? And put them on Instagram? First of all, do you have an Instagram?
Not on Instagram. No, not. I do have Instagram, yes.
Okay, and do you take pictures of your food?
Yes, he does.
Not on Instagram.
Okay, do you take pictures of your food?
I have done for previous girlfriends.
That's done. Doesn't matter. Your picture, you're trying to claim it's for previous girlfriend.
I am not a social media food picturer though.
Okay.
I do not.
Okay, so you know what? You're straddling the line. You're half Gen X, half millennial. Yeah, I'll give you that. I'll give you. You're straddling.
Well, do taking pictures of drinks count? Because you definitely do that.
Yes, I do take pictures of cocktail drinks. Yes.
By the way, I was about to just wrap it all up, and then I forgot we have to talk about something really important.
Yes.
Okay, and Daniel was reminding me. I am sitting in Toronto with the first snow of the year hitting. Daniel's
No,
enjoying
the second.
himself.
I was there in November when it hit.
Well, sorry, the first cold, like the real cold section. Okay, you're right. We have had snow before, but Daniel is in Portugal, slaving away for big picture trading, doing all sorts of things in terms of making content of Patrick. All of his great stuff. But Patrick, in the meantime, what is he doing?
Well,
Patrick, tell us a little bit about your upcoming trip and where you're going.
What do you mean? Like where I'm going?
I if I'm not mistaken, you're headed to Italy.
Oh yeah, absolutely.
And what are you doing in Italy?
Well, I'm going to go to the wine region where I have my little apartment villa.
Okay.
I'll call it a villa just for
Your
the
little
special.
apartment. And
Villa.
why are you going at this time of year?
Well, do some Christmas markets.
Oh, come on, own it. Daniel,
I'm
tell
not-
us why he's going there with this time of year.
It's the truffle. It's the truffle part.
Oh, yes, there are the tail end of the White Truffle Festival. Yes.
And Daniel was
yeah.
telling me, Daniel, tell us about what this place is like and what happens to it when the truffle folks come.
Well, as far as I'm aware, and I have been to this village in the summer when there's not many tourists there, but I believe that when the truffle festival is on, there are many Lamborghinis and Ferraris
Absolutely.
that travel all the way to this very tiny little village to have truffles sprinkled on their
Absolutely.
food.
Patrick's just owning it. Absolutely.
Absolutely.
I'm there for it.
The white truffles. But you know what? At this point, as when I go in December, they're not as fresh. The hardcore Lamborghinis are all there in like that October, November period, because literally the white truffles are most flavorful in their like first 5 to 10 days from being harvested, and so all of those really hardcore people literally are going there for the fresh serve of the thing. I'm going probably some of these are going to probably be a month old. I'm only going for the tail end of the
vintage. The antique truffles, the poor man's truffles, yeah.
Okay, well, there we go.
I won't lie, Kev. Like, really, the truffles is a thing. Like, I am looking forward to actually strapping on some skis, my friend. Living in Portugal and having traveled in all sorts of hot places, avoiding snow, I haven't strapped skis on for years.
Oh, so that's what you're doing. You're going skiing.
And so I'm going to actually spend, now that I got the place, I'm going to go back like 2 more times, probably in January and probably once again in March. And I'm going to hit some of the Alps in Italy and do some skiing and see if I can get my Canadian ski legs back.
Well,
and
sounds good.
And
Well,
so
you know what?
I'm
you're
gonna-
only like, it'll be significantly cheaper. It's probably cheaper for me to come, fly there, spend a week eating truffles, and ski with you there than it is to ski in Whistler.
Yeah.
Have you seen the prices here?
It's
It is
ridiculous.
ridiculous. It is like they have ruined skiing in North America. It is absolutely ridiculous. And I would suggest anyone that wants to go skiing in Canada or US, skip it and go to Europe. You're going to end up spending less and probably having a better experience. It's just they ruined it.
And I don't know exactly what venue I'm doing yet because I'm having my assistant look it up, but I'm going to do New Year's in Rome.
There we go.
And I'm
just a man of the people. I haven't decided where I'm gonna.
International
But
playboy.
I got
I am
my
gonna
assistant
do-
looking up, and I'll let you guys
I'm
know
gonna
where I'm
do
going to end
New
up.
Year's in Rome, which is going to be awesome, buddy.
Yeah, I'm sure it is. I'm sure it is. So listen,
I'm looking forward.
give us the
to,
update on the truffles. Let us know how
Hey,
Valdez
can I take
there
some
is.
pictures? Can I take some
You know
pictures
what?
of the truffles and send it to you?
for sure. So have a great time, buddy. Think about us while I'm shoveling my walk. Okay, you guys have
All right, take care,
Patrick,
guys.
we love you and we love hearing your stories.
Cheers,
All right,
buddy.
everyone, have a great couple of weeks. Happy belated Thanksgiving to all of our American listeners, and we'll see you in a couple
Happy
of days.
Thanksgiving, everyone.